Stop watching in disbelief as the market makes huge moves without you. Spot the next massive breakout, like Nvidia's, before it begins, then capture the backside of the trade. This overlooked volatility indicator can help you do both. I'm Jeff Holden, and we're one of the top proprietary trading firms in the world, with numerous 7- and even 8-figure per year traders. You found the right place to learn.
The breakout signal I'm about to show you is one of the most powerful breakout signals in trading. The indicator that drives this signal is very easy to use. It can be applied to any market on any time frame. And one of the coolest things about this indicator is it's also one of the most powerful mean reversion indicators. And I've never seen anybody use it in this way. So in this video, I'll show you how to combine this indicator with volume to generate my favorite breakout signal. And I'll show you how I use this indicator after the breakout to take profits and time the mean reversion trade. And at the end of the video, I'll show you one of the greatest momentum stocks of all time that is currently set up in this way on the higher time frame. So let's get into it. So on October 11th, I tweeted about MSTR. I pointed out that the breakout above 200 that occurred on that day shared some alarming similarities with the NVIDIA 500 breakout and the SMCI 360 breakout from the beginning of the year. I'm talking about this daily breakout in MSTR, which led to this. And I'm talking about this daily breakout in NVIDIA, which led to this. And for that matter, this daily breakout in SMCI, same signal, led to this. Now, I always find it incredibly helpful to study historically powerful patterns and find analogs of these patterns because patterns repeat themselves and we can quantify these patterns and we can create signals out of these patterns to catch these trades. And it's easy to assume, of course, that this is merely hindsight bias because we're looking at 3 of the most explosive moves of the year. You're probably saying, of course, Garrett, you're just showing us huge moves. It's easy for you to say this now. But that's why I showed you my Twitter post. It proves that if we study the analogs and have a signal for this trade, we can identify an NVIDIA or an MSTR before it happens and at least stack the odds in our favor in what is an incredible risk-reward opportunity. Because, of course, nothing works all the time. So let's do this now. Let's reverse engineer these trades, quantify exactly what is so similar and so powerful about these patterns, and fully outline our signal. So the indicator I want to show you is not a momentum indicator. It's not a volume indicator, even though volume plays a role here, and we'll get to that. The indicator we're going to use here is a volatility indicator. Volatility is a market dynamic that is often overlooked. Volatility is simply the magnitude of price change over a period of time. So naturally, higher volatility means bigger and faster moves, and lower volatility means consolidation, compression. And volatility moves in cycles, and I'll show you these cycles and how to measure them. I find it crucial to my trading to be able to know where we are in the volatility cycle of the stock that I'm trading. And we can use volatility as an indication of how much energy a stock has in its tank in order to gauge the potential of the trade. And this is the key here, because we have to have the imagination to trade these breakouts correctly. So I'm constantly asking myself, how much energy does this stock have in its tank to make a big move? Or how much energy has this stock spent to get to this level? Now, I'm sure many of you have heard of the Bollinger Band squeeze or the TTM squeeze indicator, which you can access from pretty much any platform. Well, these indicators measure volatility, and more specifically, volatility compression. They don't measure the full volatility cycle, which, as I said, I will get to, but they do a great job of focusing on the compression side of things and serve as a great alert for when a stock has a significant buildup of energy. So this is a good place to start, to begin to understand this volatility concept, especially since the TTM squeeze is an indicator everyone can bring up on their charts. Now, the Bollinger Band squeeze concept, which was developed in 1980s by John Bollinger himself, has been around for a while. And the TTM squeeze indicator is based on this Bollinger Band squeeze signal. John Carter over at Simpler Trading uses the TTM squeeze indicator very effectively for trading momentum and catching breakouts. He's been an advocate of this indicator, and he's a great resource for this style of trading. This is a simple and powerful concept. So check it out. Here we have the TTM squeeze indicator with its default settings. Okay, so it looks back 20 periods, uses a 1.5 ATR factor and a 2 standard deviation Bollinger Band factor. When the dots are red, it means volatility has compressed to a significant level and enough energy has built up on this time frame for the stock to make a big move. Now, if we put a Bollinger Band on our chart with the same settings and now add a Keltner channel, we can see how this indicator uses the Bollinger Band squeeze to get its squeeze alert, which I said are the red dots. So in this case, if the Bollinger Band squeezes inside the Keltner channel, we have our squeeze, right? That's the magenta Bollinger Band getting inside the cyan-colored Keltner channel. And we'll go over the significance of this later. But right now, I just want you to understand how it's built. And then, furthermore, the histogram on the squeeze indicator measures price momentum, something completely different and additional to what we're talking about here. The thing to focus on is the red dots. This means we are in a squeeze and the stock has spent time building up a significant amount of energy. The breakout occurs from this state and we get a fantastic move with plenty of energy in the tank to run. Now, it doesn't always break out like this, and it could go long or short, right? This is why I view volatility compression as pure potential. And this is why I combine it with volume to define the really great opportunities like MSTR, NVIDIA, SMCI that we showed earlier. And I'll go over this full signal in a second. But as a whole, I think this concept of volatility can be used in an even more dynamic way. So I want to take this tool one step further and visualize volatility differently so that we can see the full volatility cycle and not just the compression, in order to use this concept more comprehensively and powerfully. So first, let's take a look at the full volatility cycle so you can see what I'm talking about. So we know volatility moves in cycles, and we want to know where we are in the cycle on the time frame that we're trading. So here on this Tesla chart, we can see the volatility cycle in the lower quadrant. The light purple curve represents this cycle. So price range expands as Tesla makes a move, volatility expands, price range contracts as the price consolidates, and volatility contracts. Price range expands again, volatility expands, and we repeat this cycle over and over again. So I like to think of this volatility cycle as energy flowing in and out of the stock. When range expands, the stock makes a move, it spends energy, right? And when enough energy has been spent, it has to rest. And then when range contracts and the stock consolidates, it builds up energy. When it has built up a significant amount of energy, it now has the potential to make a big move, right? Simple, makes a lot of sense. So I want to know where we are in this volatility cycle so that I can gauge how much potential energy the stock has in its tank. So this serves as a big context for my trading on both breakouts and mean reversion setups, because we know when energy has been built up significantly and when energy has been spent significantly, right? Two meaningful signals. And it can inform me as to when to look for a breakout, how long to hold, right? When to start looking for mean reversion, like all of these things, right? So these are two trades that I took in Tesla in July. And to get this volatility cycle, we're using similar math that the Bollinger Band squeeze uses. But instead here, we're visualizing the entire cycle rather than just the maximum volatility compression, otherwise known as the squeeze. So I've highlighted where our volatility indicator gets below the magenta line, which is 1.5 ATRs, right? Well, this is the definition of a Bollinger Band squeeze, when 2 standard deviations of closing prices gets below 1.5 ATRs. This is when the Bollinger Band gets inside the Keltner channel. So according to Bollinger, this is the threshold that signifies significant compression, significant energy buildup. So if I add the TTM squeeze indicator at the bottom with the same default settings as we saw before, you can see that it is highlighting the same bars in red. So this is the squeeze. Before we address this mean reversion signal that sometimes comes after a successful breakout, let's go over quickly how we're measuring volatility here, because it's very simple. We're looking at the standard deviation of closing prices over 20 bars normalized by the stock's ATR. So what does that mean? So I'll break it down. Standard deviation is a measure of how dispersed the data is relative to the mean. A small standard deviation indicates that data is clustered around the mean, and a large standard deviation indicates that data is more spread out. So naturally, if we're looking at closing prices and we have a relatively low standard deviation, we know the closes are all clustered around similar price levels, right? So it's consolidating tightly, right? And then if we have a relatively high standard deviation, we know the closes are spread out, covering a span of different price levels, right? So price is moving and we have volatility. The higher the standard deviation of closing prices, the more volatility expansion we have in the stock. And the lower the standard deviation of closing prices, the more volatility compression we have in the stock. And in order to make this measure consistent across a wide range of stocks and varying levels of volatility, or across multiple orders of magnitude of a stock's price, we divide this standard deviation by the stock's average true range, also known as the ATR, right, which is the average range of the bars, including any gaps. So in the end, what we're asking is how many ATRs is two standard deviations of closing prices over the last 20 or 21 bars or whatever look back period you choose to use. And as I said, the TTM squeeze uses 20. And remember, expansion spends energy and compression builds up energy. And this is the key. This is what matters to our trading. So let's look at an example. So here's a Tesla chart where on the top we have a scatter plot of the closing prices through time. And on the bottom we have our volatility indicator. So notice if the closing prices are clustered around the same price levels, the distribution of closing prices will be narrow and the standard deviation will contract. Right, this is our classic Bollinger Band squeeze. And if the closing prices are spread out, like what happens when a stock starts to touch a lot of different prices or goes on a run and range expands, the distribution of closing prices will be large and the standard deviation will expand, indicating volatility expansion, right? And this works both ways. As volatility expands to the downside in the stock, the volatility cycle will rise again, right? So in other words, the indicator only cares about volatility. It doesn't care which direction, long or short, the stock is trading. And so just like how John Bollinger determined that if two standard deviations of closing prices gets below 1.5 ATRs, we have a volatility compression signal called the squeeze. We can do the exact same thing on the other side of the volatility cycle. We can create a threshold that signals volatility expansion, significant energy spent in the stock. So in this case, I'm using 6 ATRs, and that is the yellow line on the chart. And we can use this new signal as a way to prepare for mean reversion. Right? So as this suggests that the stock has spent a significant amount of energy. Now, if you're interested in this volatility cycle indicator, we're sharing this indicator in the Bionic Trader meetings on Tuesdays as part of SMB Inside Access. So for more info on that, you can visit insideaccess.info. So now that we understand the full volatility cycle and how important it is to the context of our momentum and mean reversion trading, let's put it all together and define my favorite breakout signal, the same signal we saw in MSTR, NVIDIA, and SMCI. And then I'll show you the same signal we're now getting in a very relevant momentum name in the market on a much higher time frame, a signal that should last for quite some time if it follows through. So we can use the TTM squeeze indicator for this, or we can use our volatility cycle indicator for even more information on where we are in the cycle. So We're looking for a squeeze on a higher time frame, telling us that there's plenty of energy in the tank. And then we look for a significant volume bar on the breakout. Now, if we interpret volatility compression as built up energy, we can interpret elevated volume on the break as fuel. Stocks need fuel in order for range to expand. And this is why I love combining volatility with volume. I want to see significant volume on the break. There are a number of ways you can define significant volume, and I like to use standard deviations of volume above the mean. So I'm looking for a volume bar that is greater than 2 standard deviations above the mean. This tells us that the volume bar is an outlier, exactly what we want in this case. So here we have MSTR on a weekly chart at the beginning of October, right before the breakout. And we have a big fat squeeze signal on the weekly. So the stock has consolidated enough on the weekly chart after its big run up in February, March to have built up enough energy to make another big move. It's testing the top of the range and is in a squeeze, and this is how I know it's ready. But I need to see the breakout and I need to see significant volume. So we draw our breakout level at 200 and watch the daily chart for this breakout. It occurs a week later, right? And this is what I was seeing in MSTR and NVIDIA, right? On the top panels, we have the weekly squeeze, and on the bottom panels, we have the breakout on the daily chart on a greater than 2 standard deviation volume bar. And the same pattern occurred with SMCI earlier in the year, right? Very simple, very powerful. We can do this on any time frame, but daily breakouts are my favorite. The thing to know about lower time frames is that it will take less time for the move to play out, of course, and it will take less time for the stock to work off that volatility expansion we get from the breakout. So these signals are going to be shorter moves. Now let's take a look at Tesla right now, a stock that is set up in this way on a much higher time frame. So here's Tesla on the monthly candle chart. And I'm using a log scale so that we can see the price action at lower prices easier. Let's take a look at the story of this stock in terms of its volatility cycle. So the last time it had a monthly squeeze fire long, it made an explosive cycle move during 2020 and 2021 from $26, split adjusted of course, to just over $400. Like just insane, right? The next monthly squeeze that formed traded to the downside, showing us a great example of when something like this does not follow through. Remember, they don't always work. I just see these squeezes as potential energy and nothing else, right? And I actually love this because we saw a scenario where Tesla on the higher time frame had tons of energy built up to trade much lower, and it held and continued to go sideways. This is a sign of a strong stock on this time frame. So what is Tesla doing now? Well, it's been in a squeeze all year. And now it's starting to test the breakout level at 415. So what does this tell us? It tells us that if Tesla breaks out on volume, it has enough energy in the tank on the higher time frame to run significantly over the next year or two. So what do I do about this? Well, right now I've been trading it on lower time frames, right? As this monthly breakout has not triggered yet. So for example, the start of the run from July had energy potential on the weekly chart as it broke above 200 on a delivery number catalyst, right? And the daily chart showed the same compression signal. And right, also we can see by looking at the volatility cycle that just before the election, although it was not technically in a squeeze on the weekly, it was at the low end of its cycle, poised for another move, which we are still experiencing right now. So currently, as far as this monthly chart pattern, I'm looking for a 2 standard deviation volume bar on the weekly or daily chart that closes above 415 for this monthly pattern to trigger. And keep in mind, this monthly chart is such a high time frame that it could spend time above the level before picking up steam. It could consolidate for a while as it has gotten a bit overheated right on the daily chart. So this may take time. The idea is that when we are in the environment of volatility expansion with volume above the breakout level on the monthly, Tesla might be in a price discovery environment for the next year or two, something to be aware of, whether you were a day trader or an investor. And again, if you're interested in this volume standard deviation indicator, we're sharing it in the Bionic Trader meeting, so visit insideaccess.info for more information.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with S&B to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.